Good afternoon and welcome to Maximizing Wealth. We're happy to be with you today. My name is Mike Storer. I'm the Senior Regional Director for Symmetry Partners. Just a little background on Symmetry. We are a TAMP, or Turnkey Asset Management Program. We've been working with financial advisors and RIAs for the past 30 years, supporting them in a number of different ways. Firstly, and most importantly, through integrated back office technology. Secondly, through marketing and branding to help advisors maximize their presence in the street. And thirdly, through a robust suite of investment strategies that range from mutual funds and ETFs up into and including customized tax and investment strategies for higher net worth clients. I'm joined today by Brent Sullivan. Brent is founder of Tax Alpha Insider. We affectionately call him the LinkedIn influencer in that space, but also he's, tax wealth researcher as well. So does a number of different things, but consults with advisors and vendors on taxable portfolios, products, and marketing. I'm also joined by Dr. John McDermott. John is our chief investment strategist at Symmetry Partners and has been integral in terms of launching and supporting the tax strategies that Symmetry implements with their clients. And so I want to welcome both John and Brent to the broadcast.
Thank you, Mike.
Any opening words?
Happy to be here.
Great. Good to hear. So obviously today we're going to be speaking about tax strategies. Obviously, many on the call today are very familiar with direct indexing. That's typically the strategy, the go-to strategy currently, at least in a general sense. But there are some other unique strategies that go beyond direct indexing. And two of them that I'd like to just highlight briefly here before we get into our discussion are one where some of the different strategies that, or at least issues we've come across with clients, range from business owners that are wanting to sell, but potentially could have a large capital gain event when they do that. And secondly, we come across many clients, especially with the great run up in the market where they have very high concentrated positions, very low cost basis. I'm thinking names, John, like Apple, Microsoft, all these great technology companies that have really, really grown. And a lot of advisors that we talk to have clients coming in with these very highly appreciated stock positions and really don't know what to do with them. As a matter of fact, in my long tenure in this business, that's always been an issue, Brent. I think when you think about the one problem that advisors have is I've got clients with these stock positions, but they just don't want to sell them. Or if they sell them, there's going to be a very a high taxable event there, and they just don't want to do it, or they don't want to do anything. Well, lo and behold, there are some strategies today that Symmetry implements that can actually help mitigate the impact of unwinding those positions, or even mitigate the impact of selling a business where a large capital gain might ensue from that sale. So the first case study that I'd like to just really briefly talk about is one that I actually worked on, and this had to do with a small portfolio, I should say a small number of stocks that were highly appreciated. With the great growth we've had over the last 10 years, especially with some of the well-known stock names like Tesla, Apple, we've seen many clients come to us with very highly appreciated stock positions, low cost basis, and it's great that they've had this great growth. However, the flip side of that is, okay, how do I use these monies without paying taxes? And it's always been a challenge. Challenges, this particular client had 5 stock positions totaling about $6.3 million, 5 stock positions, $3 million of capital gains in the portfolio. However, about 90% of the gain was in one stock position, General Dynamics. And so the advisor for the client came to us and said, hey, is there anything that Symmetry has available that could help this client do 2 things? Number one, diversify the portfolio away from just 5 stock positions. And while you're diversifying it, help to mitigate any issue with paying taxes. There are more complicated cases, but in this particular case, it was pretty straightforward. $3 million in gains, almost 90% of it in one particular stock position. The client liked the positions he had. However, he did recognize that it could be risky just to own 5 stock positions. So we made a determination that we could diversify the portfolio into a more kind of US market index like portfolio, and at the same time mitigate any tax implication in doing that through this diversification. In this particular case, General Dynamics was the large position that we wanted to diversify primarily because it had the most gain in it. So what we'll do is on the long end, it's a long short strategy. On the long end, we'll look to diversify into a Russell 1000 portfolio. It's a basket of US stocks, the top 1000 stocks. We'll immediately diversify the portfolio away from just the individual General Dynamics position. On the short end, because we will short as well, we will diversify into other stocks that are in the same industry as General Dynamics, thereby diversifying that position there. Once I have the conversation with the client and the advisor, we then bring our research team into the picture and we do an analysis of what the gains are. We also consult with our sub-advisor that we utilize to help with the tax strategy. And we come together with a proposal that we can either help deliver with the advisor or the advisor can deliver on their own based on their expertise around our strategy. The end result was the client really liked the option in terms of being able to unwind this position, diversify it, and not pay taxes on it to a certain extent. You know, there are other options. One is direct indexing. The problem with direct indexing is that after about 5 or 6 years, you run out of losses, and then so you're stuck with a portfolio of stocks that still has gain in it. With our strategy, we take it to the next level. We're able to bank losses for close to 20 years. So we can continue to bank those losses and continue to help offset any tax implication of selling any of these stock positions over time. The one comment I got from the client, husband and wife, is that they had kind of delayed making a decision about it for about 6 months. And once we actually implemented, they were saying, I wish we had done this 6 months ago because we feel much more comfortable that we've made a decision. And now we have a strategy that can help us continue to build wealth, but at the same time, do it in a very tax efficient way. John, I don't know if you want to just chime in on kind of that strategy that we implemented there.
Yeah, I think you hit on the key points. To me, the biggest benefit right out is the diversification, right? So at Symmetry, we're about minimizing taxes and being tax efficient in everything we do, but we're also about risk management. And one of the tenets of Symmetry investing is being diversified. So when a client arrives at our door with an ill-diversified position, certainly a single concentrated position from years and years of participating in a employee stock ownership program, or just somebody who hit it big with Apple or Microsoft, we want to help that client out. And it's difficult. A lot of clients have, Brent and I have talked about this before, a lot of clients have affection for the stocks in their portfolio, right? They've done really well by them. But we feel like it's the advisor's job, and our job in working with advisors is to let them know the real risk they take to their long-term wealth by having such an unconcentrated portfolio.
Yes, and you bring up a good point, because in this particular scenario, the one of the concerns of the investor was diversification. So they wanted to diversify away from the positions they had. We come across situations where the investor may not want to diversify. They like their stock, as John, as you just mentioned out. And so we can run the same strategy, but do it in what we call an overlay format, where we don't touch the underlying stock, but we can generate, or what we like to say, bank losses. So at some point in the future, when the investor would like to utilize that stock or utilize the losses to offset other gain events that may happen, they can utilize this asset to do that. So in one case, we're diversifying out of a concentrated position or a concentrated stock. In another case, we're just overlaying on the underlying stock, or what we call collateral, and we are just banking losses for a future event that may be the sale of some of the stock, or perhaps other events that occur while that goes on. And so that's scenario number one. I think it segues us in, okay, what are those other events that could occur? One of them is a business owner perhaps selling his business in the next year or 2, 3. Preferably, if we can catch a business owner 3 to 5 years before they sell, it makes a lot more sense. But sometimes we run into a business owner that maybe told the advisor, hey, I just sold my business. or I'm selling my business in 6 months.
So a few months ago, we had a client call in that was going to be selling their business on July 1st for $3 million. The cost basis on the business was about $1 million. So they wanted to see if we were going to be able to minimize the tax impact for this year on the sale of the business. And so they had about a $2 million taxable account already with us. We moved that over as quickly as we could into a 145/45 long short strategy. And then when the sale of the business occurs on July 1st, and we get the additional $3 million of capital, we're going to leverage up the extension to a 225/125 that, our estimate right now will generate about $800,000 in short-term capital losses by the end of the year, which will save the client a significant amount on their taxes. With this specific client, we had to look at a few different variables within their account. The fact that we only had about 8 to 9 months to execute a pretty sophisticated plan to reduce their tax impact on the sale of their business. We had money that wasn't here yet. We also had accounts at other custodians that we needed to move around, and that we needed to create a custom plan in terms of the sizings of the extensions based on the current account values. So there were a lot of moving parts that we needed to put together to ultimately help maximize the after-tax return for this client. A number of different individuals are involved in designing that case. Our investment team, our advisor consultants like myself, as well as our sub-advisors over at Quantino for the case. And, all of us kind of overlook all the details of the case, put our minds together to design what we believe is the best solution for that client. The end result was a very, very happy client, telling them that they're going to reduce their tax bill from the sale of their business by almost 50%. That's something that's truly meaningful to them and puts a lot of dollars back in their own pocket.
So I'll stop there. Brent, I don't know if you have any questions out of the gate.
I was going to ask Brent what he's seeing or hearing from advisors in terms of tax concerns are centered around capital gains.
I like to put the long short strategies in context in terms of time. And the first one is that it's very difficult for an entrepreneur to predict when they're going to sell their business, especially on the 5-6 years out. That's like almost impossible to predict. And so I'm just curious, does it make sense to start banking those losses now, even if you're not sure you're going to sell your business? And that's the first question. When should I enter this kind of strategy? And the second one is, what if I've already done it? What if I've already realized? Maybe some concrete example of that. I know you alluded to one earlier, but really emphasizing there's pre-liquidation and there's post-liquidation or post-liquidity, and like that this strategy can really show up in both circumstances. But more detail there would be great.
Yeah, I think you're right, Brent, in that the sales can often come without a lot of warning, and thinking that you're going to have 3 to 5 years to get ready is probably unrealistic. And I think another problem that business owners face, a lot of their wealth is tied up in the business. So where does that original capital come from in order to fund a 150/50 or 145/45? And it's not clear that they actually have the capital. They may not have the capital, right? If their wealth is tied up in the business primarily. But we've seen estimates from our sub-advisors, and I'd like to give a shout out to our sub-advisors in this space, as Quantino Capital, and the other is AQR Capital. Both are great partners. Both are very experienced in the world of long short. Quantino is dedicated to direct indexing long short as kind of a single product company, single focus company. They've grown to, I guess, around $8 billion to date over a very short period of time. AQR Capital, which is a larger money manager, around the total AUM of $100+ billion across many different types of strategies, has gone from 0 to 8 billion in about a year or so. So the strategies are really getting a lot of pickup, and our two partners we feel like are the real innovators and leaders in the space. So we're very happy to be doing business with them. But we've seen some estimates from our partners that, with a significant leverage, say of 250, 150, which is about pushing it as far as you can. You can realize about 75% of the capital employed of of an initial investment in year one, provided you start on January 1st, right? So January 1st is better than June 1st. But, assuming it's linear, if you started on July 1st, you'd still be able to you'd still be able to generate losses in the vicinity of 40% of the capital employed. So those are really significant losses to be able to generate on short notice. So is it ever too late? I guess in the case that you sold the business on December 30th and told your advisor on January 2nd that you sold the business, it's too late. But with a little bit of future planning, which is, can we time the sale to be in Q1? Can we get the capital in advance of the sale? At least we've done that. We kind of do like a 2-stage implementation where the entrepreneur might have some capital to put into the strategy to start generating losses in advance of the sale, and then once the sale is made, use the rest of the capital to amp up the amount of capital that's employed. So even though I agree that these things are unforeseeable, it only takes a little bit of planning. Talking about a year or less notice that you can have a significant impact on the tax hit from a sale of a business.
I would say the key thing, Brent, is having the conversation, right? And so because these strategies, I won't say they're new, but they're newish in some ways. What we try to spend our time do is educating advisors that work with us about these strategies, so then they can take this information and talk to business owners. And we've had some success in some areas with it, but I think it's education for the advisor to make their clients aware of these strategies, because they can be very beneficial. We've had advisors tell us that in some cases, the client decided to pay the taxes. Okay, that's fine. But I think, whether it's pre-liquidation or post-liquidation, if the advisor understands what these strategies are and how they work, I think it's important to at least get the word out that above and beyond everything else you're doing, you're trying to save the client taxes, whether it's in a direct index or in an ETF portfolio that's very tax efficient. We have these other strategies now that go to that next level that really can impact, on the sale of a business or some of the other scenarios we talked about.
Yeah, I mean, one of the things that really sticks out to me about long short is that the investor does not lose liquidity. And so if we're comparing it to an irrevocable trust or an exchange fund, it really depends on the specific application, specific use case. Long short, you still have access to that capital. And this can be a huge difference if you want to reinvest it in a subsequent business, other use cases like that. But tell me more about liquidity management. That's a first question I've got for you guys. And the second one is that Symmetry does something pretty interesting, was that it acts as a wrapper around the sub-advisory community. So the value that you're providing there from a reporting, coaching, also consultative perspective is something I'm pretty interested in. If you could just tell me a little bit more about that.
Sure. We're, as I mentioned, proud to be partners with Quantino and AQR. We feel like are leaders in the space, and in a way, we're leaders in the space as well, in that we're providing this conduit for advisors to access Quantino and AQR with the help of a TAMP, with the help of our investment specialists and our research team. So we're educating advisors, we're engaging in conversations with advisors and their clients, we're doing case design for more complicated strategies. So I feel like we're really providing a great way for advisors who on the face might be very wary of sophisticated strategies that are employing leverage, which is kind of a dirty word for advisors, or shorting, which certainly has its negative connotations as well, in a risk managed portfolio. So I feel like we're really serving our advisor base well in providing them access to state of the art, kind of cutting edge tax solutions. And I agree with you, Brent. I think, the access to the funds, the the management of diversification makes this superior, at least for diversifying concentrated positions, as compared to the alternatives like an exchange fund or charitable remainder trust or a CLAT or whatever the advisor might have in mind.
Yeah, I would just say on the liquidity front, just a real life example where I'm working on a case right now where the advisor and the client want to put money into the strategy, but they also need money along the way to fund trusts for the grandchildren. So we work with our partner Quantino to say, look, here's the chunk of money that's going to go in. Oh, by the way, we're going to need $160,000 out of each account, out of each trust to be taken out to fund these IULs that the advisor's putting into. So Quantino's fine with that. It could impact the losses that you can generate because you have a little less in the way of collateral, but there's complete liquidity to do things with this strategy outside of that's locked up and you can't touch it. So liquidity is definitely something that's important in some cases, and in this particular case it was. So I haven't seen any issues around that. And I would say, to John's point about working with Quantino, especially in AQR, is that we have the ability to provide reports so they can see performance, they can see the positions that are held, all inside of our technology platform. So we make it really easy for the advisor to not only present the strategy, but after it's presented and the client says yes, how do I report on it? And I think that's even bigger. What's my progress? What are my losses so far? How's my performance? All of those things are important for the client to see.
Yeah, those reporting, which is a really nice thing for advisors to take note of, is part of the monthly reporting is the amount of the losses that have been realized in that month. So they could actually see the effectiveness of your strategy through time rather than having to wait on a quarterly or even annual basis to see what the impact of the taxes has been. The strategies are by both of our partners that we've used have been primarily implemented in S&P 500 securities. So we don't really have control of the liquidity of the underlying that's brought to the table as collateral, the 100. But in terms of the extension, the 30/30 or the 45/45, they're S&P 500 names.
Yeah, I mean, it gets really gnarly when you get away from the S&P 500 in terms of borrowing and shorting and things like that. So yeah, it's good that it stays core or close to core. One question that comes up a lot of times, advisors will ask me about idiosyncratic risk or stock specific risk, particularly in the shorts. But I'm just curious, to the extent you can tell me about risk management of the 130/30, 250, 150, however far you want to go. Tell me about risk management.
So it's a really the risks of the portfolio that are immediately recognized by the advisor are margin and the risk of margin call, which Mike has spoken to a little bit, which is very manageable. And I can't say there's no risk of margin call, but the risk of a margin call in a normal environment with that amount of leverage and the collateral behind it is very small. The other risk that comes up is the shorting risk. So we all know stories. Everybody knows the story of GameStop and bad stocks that are heavily shorted going to the moon, and the losses on a short are theoretically infinite, right? So how are the shorts and longs managed? Well, there's hundreds of positions on either side of the long and the short. There's position limits. There's, I think, the average position on the short side, I think I recall seeing something that said it was about 30 bips. So very much cognizant of concentration risk on both the long and the short side of the book. And it's actually, I think it might be a good time to introduce the idea of that for both of our sub-advisors, the long and shorts are part of a larger alpha strategy. They certainly have an aspect to play in diversifying a concentrated position. But once you kind of get past that hurdle of managing that concentration risk, The longs are put on and the shorts are put on as part of an alpha generating strategy, which is multi-factor in nature. Those of you who are familiar with multi-factor investing would recognize, long value, long quality, long momentum, and short the opposite. The strategies actually have some faster moving signals like investor sentiment, because you need the signals to be moving faster in order to affect the trading. There has to be a match between that. So there's an expectation that those long shorts will not have a zero expected return, but they will actually have a positive expected return through the multi-factor process. So even outside the consideration of tax benefits, there is a method to the long shorts that should bring benefits to the portfolio.
I think it brings what market beta one.
Yeah, so I know we kind of skipped right into the case studies and use cases and our risks, and at its basic level, what's going on is somebody brings $1 million to the table in marginable securities. That could be ETFs, mutual funds, single position stocks, bonds, and that $1 million of marginable securities is used as collateral to borrow, right? And the borrowing in a 130/30 would be $300,000. That $300,000 of borrowed against your collateral will be used to invest in securities long, right? Normally equity securities, S&P 500 names, a couple of hundred securities long. And then on the short side, $300,000 will be sold short. And again, across hundreds of securities, no single, I think the position limit on the short side is 3% of the short book will not be concentrated in any one single name. There's a cost to this, the cost of the financing. It's not an inexpensive strategy, but we don't think of it as being a terribly expensive strategy. You need to pay on your margin, right? So there's a margin rate. Typically, for our partners who are both working at Fidelity, it would be Fed funds plus 50 bips, say. But when you short a security, you get access to the proceeds, and the proceeds are deposited in an account where you get a rebate from that, right? You get a rate of return from it, and typically that would look something like, say, Fed funds minus 25, right? So that 25 basis point haircut is to cover the cost of shorting. So if you look at long, say, Fed funds plus 75 and short, or 50. Fed funds plus 50 and short Fed funds minus 25, your financing costs are a flat 75 basis points that are immunized against changes in the Fed funds rate. So there's not a risk of short-term rates rising and having your financing costs go very, very high. And since you're only employing that on 30% of the portfolio, right? So it would be 0.3 times 75 bips. I should have picked an easier number to play with. But whatever that turns out to be. So let's say that the spread was 100 bips, 30% of that would be 30 bips would be the cost to the portfolio, right? And then there's the cost of the manager, which is typically around 50 bips. So the client is getting this strategy for over and above what they're paying their advisor. A marginal cost of the strategy would be around 80 bips. I'm an economist. I think in terms of marginal, they're going to be paying the advisor whether the money is in a direct indexing long only, or a 130/30, or in a diversified portfolio. So marginal cost would be somewhere 80 to 100 bips maximum.
And the other thing that I like to bring into the conversation too, when you talk about costs, because obviously, it's important to understand all the costs that are there, the advisor costs, but sometimes we don't think about the benefit of this strategy too. I think it's anywhere, John, from 2 to 4% after tax return as well. So you can look at the after tax return, and the savings you get from that part of the equation will help offset the upfront cost of implementing the strategy as well. So you can't forget that you're saving on taxes too, especially gains taxes, and that has to be factored into the overall cost of the strategy as well.
Yeah, and that 2 to 4% figure thrown around for, say, for the 130/30 is based on the following math. You generate 10% losses, and then at the long-term capital gains rate, 10% losses corresponds to 2%. At the short-term capital losses, at the highest rate, it would translate to 4%. So somewhere in that range. Obviously, if you're employing higher leverage and you're generating more losses, that those annual tax savings could be higher. But then again, the financing costs would be higher as well.
If somebody's like just getting started with tax, they're trying to realize that there's value in this, that it helps them differentiate their practice. I mean, what's the one takeaway you would give them if you're like, wow, direct indexing is maybe dipping your toe in the water, but short is sort of like cannonballing in the water, and you're fully bought into tax management as a practice differentiator. Like, well, how do you communicate that to your clients? Am I getting it right? How do you think about it?
No, you are definitely getting it right, and I think there is certainly we offer long only direct indexing as well. We do it in house, and we find it appropriate for some clients who are either not ready for the sophistication of a 130/30 or don't feel like they need the losses right away and they don't want to pay the additional costs associated with it. So we see it as a continuum. And I actually have used this talk track before where, there is a continuum of tax loss harvesting. It starts like with an individual investor looking at their statement in the middle of December and saying, hey, what's in a loss position? I should sell that and save some money on my taxes, right? And then that moves to the advisor, and then it moves to the advisor being more systematic about it throughout the year. And then it led to the breaking down of, well, I only have ETF and mutual fund positions. This would be great if I had individual stock positions. I could do it to scale. And then, the latest evolution is, well, I can not only use individual securities, but I can do long and short. In a 130/30, I'm getting 60% more exposure to the market and having many more names from which to harvest from. And the best thing is that the benefits don't go away because I've got the shorts to harvest losses from when markets have risen. So I view it as an evolution as well as a continuum, right? I think all of those are valid practices at any level, right down to looking at your statement on December 15th, all the way through, 250, 150. Very much depends on the nature of the case that's presented. So what's my one takeaway? Generating capital losses is a good thing for your clients because you don't eat pre-tax return, you eat after-tax return. I steal that from Cliff Asness. He likes to say that a lot. So, and I've actually encountered clients and or advisors said, well, I don't really need capital losses. I'm not going to liquidate. People have events. They have health events that require skilled nursing care. They have a liquidity event in that they want to sell a house and buy a bigger one, or want to buy a second house. It's hard pressed for me to think that your strategy is I'm just going to hold all my gains until I die and get to step up in basis, right? These losses are beneficial. They might not be beneficial now, but I think that you will be helped by the generating capital losses and the ability to bank them, as Mike says. If you don't have an immediate need, and certainly if you have one of these use cases like highly appreciated account, concentrated portfolio, transitioning from one portfolio to another, or just taking distributions, there's a lot of uses for losses. And I think, I don't know if I saw this on your blog, but any advisor who's not taking into account taxes is not serving their client well.
Yeah, there's just way more to do.
Yeah.
And tax is a crucial, it's like a crucial practice differentiator. It's hard also. Like that's real value. A lot of
Yeah.
times when I'm talking with advisors, they say that like sophisticated tax planning is really what closed the deal.
Yeah.
And I mean, I can't emphasize this enough. I mean, the more robust the palette is to solve the individual use case, as John said, like depends on the use case, but the more robust the palette is to solve that use case, the easier it is to win an end client's confidence.
Yeah. We've had, yeah,
Get good results.
sure. We've had, in a couple of instances, obviously these strategies we think do a lot of good for investors, but it's also done good for advisors in terms of them being able to kind of fight above their weight class, so to speak. Maybe they've always wanted to get into the high net worth space and haven't been able to get there because maybe they don't feel like they have the right conversation to have or the right strategy, perhaps. This allows them to have that conversation. And, a lot of times, advisors, will tell us, I don't have anybody like that in my book of business. And then all of a sudden we get a call 2 weeks later. Oh, by the way, I talked to somebody that has an interesting situation. Could we talk about this and get your research team involved to look at a proposal? So don't be surprised. Sometimes you may think I don't really have any clients like that, but you may have a business owner client. You may have someone that comes across your desk with a small IRA, but by the way, I have this Apple stock that with $6 million in it that I don't know what to do with, or I can't do something with it because I'm going to pay taxes on it. Now you have a conversation to have with them.
And Brent,
Go ahead, John. Yeah.
we have to be careful. We're not tax people, right? We're not CPAs. We're not estate lawyers, but we do engage with those professionals who are associated with the client, along with the advisor, right? So we can let those professionals know what we can do with the long short strategy, and they can think about how to best implement that, whether it's putting it within a irrevocable trust or using it to decant an irrevocable trust, or however they want to utilize the tool. That's what's nice. We can talk about what the strategy, what the tool in your toolbox or what's on your palette can do for you. And then, yes, let's get the professionals involved. Let's get the tax professionals involved. And we've had good success with that. And certainly when you start going up market and you're dealing with somebody who has, tens of millions of dollars in stock, they have an accountant, they have an estate lawyer, right?
Yeah, it's required. If you don't have like a sophisticated tax planning practice, you're just leaving opportunities on the table, more or less. And so it's good to have partners. It's good to have experts within arm's reach that can actually help you deliver on some of the really complicated stuff out there. I mean, that's what's interesting about Symmetry. I mean, I'm curious more about the consultative nature. We've gone through a couple of case studies, but what are the kind of things that, I don't know, maybe some interesting cases that have come through? Mike, you mentioned one recently.
Yeah.
But I'm curious about what advisors are actually asking, because that's
Sure.
where rubber meets the road.
Well, I'll just throw one out there, and I won't name the stock or the people, but it's an interesting kind of situation. I don't know if the audience or you are familiar with NUA stock, which is net unrealized appreciation. It's stock that sits inside a 401k and, can be highly appreciated. It could have low cost basis. The client wants to know what they can do with it. There is a process to move that stock out of the 401k. It does in kind of high level, you can move the stock into an outside brokerage account without incurring any gain. However, when you execute on that, there's a few eligibility requirements that have to be met to do it. When you make that decision to move the stock outside, you do get to move the stock out with no gain incurred until you sell it, but you do incur ordinary income that's added to I should say you incur the cost basis of that stock into your ordinary income in the year that you execute on this NUA strategy. Now, obviously, if it's $1 million in cost basis, that's going to get added to your income, but if you do it at the opportune time, and we're discussing this with some accountants right now, but you have an opportunity here to take the asset, the stock that comes out, run the Quantino overlay strategy on it, generate losses. You're going to have a tax bill next year, an ordinary income tax bill. You can sell some of the stock, use the losses to offset the gain on the sale of those stocks, and use that sale of stock to pay the income tax on the ordinary income that was increased by the removal. So it's an interesting, unique strategy, but it's something nuanced that, depending on the client and if they're willing to do that, it's a strategy that can work. In terms of moving the stock out of the 401k, using it as a collateral to generate losses. We know that we have a larger tax bill because of the cost basis being added to your income. Let's say it's $1 million, highest tax bracket, you may be $400,000, $300,000, depending on the highest tax bracket. You can sell enough stock using the losses to offset that sale and use that money to pay the tax. So it's a way to unwind the position. Again, we're doing some exploration on it, but it's a unique kind of scenario that we're doing more research on to see if it might be work. And we're bringing some very high-powered tax accountants into this as well to get their opinion on it as well.
So I'm familiar with that case, and it's actually a great illustration of somebody coming to the table with a lot of things that are going on simultaneously that are potential taxable events. So this couple are considering selling a home that has a gain greater than the allowance, the one-time allowance for sale of primary residence, and buying another home, right? So they've got a need to minimize capital gains there. They have highly concentrated stock positions from years and years of working at the same company and the company being very successful. So, we've got at least three aspects of their life at this point in time that through the case design process, we're going to help them manage through.
Yeah, I mean, one thing that this comes up all the time when I'm talking with advisors is that they don't want to be surprised, because when they're surprised, of course, their end clients are surprised.
Mm-hmm.
And like, tax is one of those things that creeps up on you, and you don't want to be handling a tax situation at tax return time. You want to be handling it while you can actually affect the outcome.
Right.
So my ethos, I need to update my tagline, which is no more tax surprises.
Yes. Yeah. I think I would say the other thing too, when you talk about case design and working with Symmetry, one of the I think the integral parts of talking about these strategies and implementing is the ability and the requirement almost for us to work very closely with the advisor. So we're talking to them, we're talking to the client, we're a resource for the advisor. They're not going in there alone. They can use us as much as they want or as little as they want, but I really look at it as a partnership in terms of investments, but also these tax strategies where we're helping them with case design and we're talking to the clients. We had clients come in to we do presentations to as well, so they can understand the strategy better. And it can be a long process. Sometimes it's quick, sometimes it's a long process, but I like the fact that we're able to bring not only myself, the advisor, the client, our case design team, our research team together to come up with the right implementation. And then we can, run it by the experts on the tax side, the advisor, and the client sees that this is not just some other model that someone's putting into. There's actually been a lot of work done behind the scenes to impact, how much money I keep in my pocket.
Right. And I think I like the way Mike characterized what we do, because we're not a pass-through here. We're an integral part of the process. And I didn't mention before when we were discussing fees, the advisor client, the client will pay the same fee whether they go directly to Quantino or AQR or whether they come through a partner like Symmetry. We've arranged it to be that way. So we're not working for free, but there's at the other end, the client isn't paying extra, or the advisor's not paying extra for Symmetry's assistance in navigating this process. One of the we talked a little bit about this, Brent, when we spoke last time, was I have been amazed at the use cases that have arose from talking with advisors, right? So once we come to the table and say we can, with the help of our partners, we can generate capital losses, especially our accountant friends, their ears perk up. Oh, well, let's put it inside irrevocable trust. Let's do this. Let's do that. Um, Way more, way closer to the problem, which, when you talk about rubber hits the road, way closer to the problem than I am. And we've gotten some really good insights on how long short direct indexing can benefit clients through working with really innovative advisors.
Yeah, I mean, one thing that comes up all the time, this is like the idea of an ossified portfolio or a locked up portfolio. So a really like, let's take a direct indexing portfolio that's 20 years old and it's well above cost basis. And so the opportunity to harvest losses is has almost evaporated. There's exceptions, but let's just assume that the portfolio's really, really far above basis. I mean, it, talk to me about how long short can address that particular case, because it opens up a whole new possibilities for managing risk over time, rebalancing in a tax efficient manner. But talk to me about direct indexing transitioning into long short.
That's a really interesting point in that initially that was our when we talked about, well, who'd be interested in this, right? Turns out a lot of people are interested in it for a wide variety of reasons. But when it first came to our attention 2, 3 years ago, maybe 3 years ago now, um, that was the talk track. Like, oh, there's these parametric Aperio portfolios that have been doing direct indexing and they're paying the fee and they're not getting any benefit, and we should roll them into the direct indexing. And we've had a few of those. We've had a few of those, but actually, it's been the more, I won't say interesting, but the more complicated situations that have really compelled people to look deeper, or compelled advisors to look deeper and to look under the hood. But our partners assure us that it's a fairly easy thing to do, is to put the extension on a ossified portfolio and have it start generating losses and refresh the basis of those securities.
Yeah, I mean, I mean, John, you make a great point there. So there's sort of an urgent use case, and the urgent use cases are the one that Mike started with, which is concentration, maybe a liquidity event with capital gains realization, and really that getting pulled to the front of someone's brain. That's a very
Yeah.
urgent case. But then there's non-urgent case, which is, oh, my direct indexing portfolio is ossified. Maybe I'm paying a little too much, but yeah, I'll get to that next year.
Right.
But the urgent cases are super interesting. That's where the boots on the ground experience is pretty revealing.
And I feel like we're just at the beginning of long short direct indexing, and Quantino and AQR are leaders in the space. It'll only be a matter of time before others get comfortable with it and enter the fray. But again, we're comfortable that we're with the thought leaders in this particular space at this time.
Yeah, I would note that's a good point, because when you think about Quantino and AQR, these people, they do long short. They've been doing it for a very long time. It's not like they just decided yesterday that shorting stocks was a good thing to do. They've been historically doing this for a very long period of time. So, our research team led by John have done, extensive due diligence on who we work with. And we've had a great long-term relationship with AQR, Quantino as well. And we feel very comfortable with the sub-advisors that we bring to bear with our clients. So,
Yeah, I think their background is, their roots are with hedge funds, right? So as compared to some of the other direct indexing providers where their roots are long only, right? So you kind of gravitate to what you do. So the fact that their roots are in hedge funds makes them very comfortable with buying on margin, makes them very comfortable shorting, managing the risks of margin calls, of short squeezes and things of that nature. So uh, good partners.
Brent, I thought you would ask you asked the question earlier about kind of unique use cases. The other one that I think it's not unique in some ways, but I think what I've seen a little bit more, and I've actually utilized it in the first case I did, was it gives you another tool within that asset location strategy, right? Where you're trying to put taxable investments, or stocks that are more tax efficient outside of a qualified plan and less tax efficient inside. And so this just gives you another tool as well to kind of play in that asset location, tax location strategy, and enhance it because you have that long short going on as well. So that's another area where I've seen it being used, where we've used it a little bit.
Yeah, location is still one of those. I feel like it's a frontier. It's a very foundational concept in wealth management, but still like just really not fully explored yet.
Right.
So it's good. It's good to see innovation there.
Yeah, absolutely. It seems weird to put a fixed income inside a 401k, or a qualified plan, but sometimes that happens when you're looking.
I don't judge. I mean, come as you are. That's what I say. But leave with tax in mind.
Absolutely. Yep. Mm-hmm. All right, we're coming up on time. So, John, I don't know if you have any closing thoughts on today. Kind of in general.
I'd just like to thank Brent and his time for his time, and actually thank him on behalf of all advisors and the taxable investing community out there. I think you're doing great work and calling attention to firms like ourselves and to more generally to issues of tax and their importance is a noble undertaking. So thank you for that.
Yeah. And Brent, any final words from you?
No, I mean, call me back anytime. I love talking about this stuff, so it's been a pleasure. And I love the concrete use cases. Mike, that stuff is super powerful.
Right. Great. Well, Brent, we really enjoyed being with you today. Dr. McDermott, thank you again. And thank you all for attending. If you have any further questions or want to talk further about this strategy, feel free to reach out to Symmetry Partners. We'd be happy to talk to you about tax strategies that we think will help your clients. Thanks. Have a great rest of the day.